What if I told you that the secret to predicting the next major move on your chart isn't hidden within a complex mathematical indicator, but in the raw visual story of a single candle wick? Have you ever wondered why most retail traders completely fail to read these obvious clues, turning high probability price action setups into devastating losses? Let me bring you into a reality that completely transformed my perspective on charting. Candlestick formations are, without a doubt, the most vital price action signals you will ever lay eyes on. These little blocks of data aren't just shapes, they are direct messages. They tell an unfolding story of exactly what supply and demand are plotting behind the scenes. When you truly understand how to decode these patterns, you gain the uncanny ability to read the market's next step. It doesn't matter what your personal trading plan looks like. If you start weaving these baseline candlestick concepts into your execution, your win rate will shift dramatically. Yet, it blows my mind how the vast majority of traders still look at a chart and completely misinterpret what these candles are trying to say. In our journey today, I want to walk you through some of the most fascinating candlestick patterns you'll ever encounter, alongside the deep raw psychology that fuels them. Once you see it, your view of the charts will never be the same. From there, we are going to look at the real secret weapon. How to flawlessly marry these patterns with core price action tools like key structural levels, Fibonacci retracements, trend lines, and high probability confluence zones. If you're ready to master this visual language, take a quick second to smash that like button. It keeps our team fueled to create more free masterclasses like this. And subscribe to the channel if you're new around here. Let's dive straight past the intro. To kick things off, let's address the core question. Why are these formations so incredibly critical? Candlestick patterns are your early, leading indicators of current order flow. They show you exactly what the buyers and sellers are doing right now, giving you a crystal clear lens to anticipate their next move. But I need to give you a quick warning. Looking at these patterns in total isolation is a trap. Without extra confirmation, a single candle can easily deceive you. To unlock their true accuracy, you have to frame them within a larger context, combining them with historical key levels and zones of confluence. Let me map out the elite list of highly effective patterns that show up constantly on our charts. Our first character is the long wick rejection. The structure tells you everything you need to know. A tiny, real body resting on top of a massive, dramatic wick that has fiercely rejected a specific price zone. This is a classic trend reversal signature. Imagine the market riding a steady downward slide. Suddenly a long wick rejection prints, and the entire trajectory violently flips. In this scenario, the actual color of the candle doesn't matter. Red or green, the story remains identical. Through the lens of pure price action, the sellers tried with all their might to close another dominant bearish bar, but they failed catastrophically. They completely lost their momentum. Simultaneously, a wave of buyers stepped into the arena, immediately absorbing the supply and driving the price back up. This massive lower tail is a permanent monument to a major structural rejection, signaling a high probability reversal to the upside. The exact same plot unfolds in reverse. The price rallies aggressively, hits an overhead ceiling, and gets slammed down to leave a long upper wick. It tells you the bulls have run completely out of breath. The bears have hijacked the session, and the price is preparing for a downward slide. Let's look at a live example on the Eurodollar EUR/USD 1-hour chart. The price pushes lower, sweeps into a major historical area, and leaves a pristine long wick rejection candle. Right on cue, the market reverses course. As I mentioned, the signal is strong, but it gains its true power because it didn't just happen anywhere. It fired directly against a historical support zone. You can even layer this exact dynamic with smart money concepts, which I will break down for you in just a moment. This brings us to our second high probability pattern, multiple rejections. Think of this as a long wick rejection on steroids. Instead of just one candle, you have a tight cluster of consecutive candles all leaving wicks that repeatedly stab into the exact same price zone. Picture a chart where the price drops aggressively, hits a floor, and violently bounces, mapping out a clear line of support. Later on, the price wanders back down to retest that exact boundary. As you watch the screen, you notice 3 or 4 candles in a row printing long lower wicks into the zone. This visual tells you that the sellers are desperately trying over and over again to force a structural breakdown, but the door is completely locked. Every single time the price dips beneath that line, buyers instantly flood the order book, creating a sequence of wicks that practically screams an impending long trading opportunity. If you flip this upside down at a major overhead resistance level, multiple upper wicks prove the sellers are holding the line with immense capital, confirming a massive shift in momentum to the downside. Our third pattern shifts away from rejections and focuses purely on structural velocity. The momentum candlestick. This is a simple yet devastatingly effective combination of two consecutive candles of the identical color, where the body of the second candle is visibly larger than the first. From a price action perspective, this is a glaring green light showing a sudden surge in market speed, signaling that the current trend is highly likely to continue. Imagine looking at a major structural level where the price has been stalling out, leaving tired wicks. Suddenly a solid green candle prints, followed immediately by an even larger dominant green candle that breaks away from the zone. This tells you the buyers have officially taken the steering wheel, injecting massive bullish momentum into the asset. The path of least resistance is now straight up, giving you an ideal entry trigger. Let me give you a quick pro tip here. If you're looking at a bullish momentum setup and that second giant candle has absolutely no wick on its top, it means the buying pressure stayed completely relentless right up to the final second of the session. It's an incredibly bullish sign. The same holds true for a bearish momentum candle. A total absence of a lower wick means the bears were aggressively shorting until the closing bell. Now, a word of caution regarding these massive momentum bars. When high-impact economic news drops, it can trigger giant, erratic momentum candles that completely ignore your technical structures. Because of this, a professional trader must always stay locked into the macroeconomic calendar. To keep my team updated on fundamental analysis and breaking news, we rely entirely on Fastbull. It is hands down one of the most accurate financial platforms out there, providing an incredibly detailed economic calendar that I personally scan every single morning before I touch my technical charts. They even feature a 24/7 live financial news stream, so you are never blindsided by a sudden interest rate decision or policy shift. If you want to integrate these institutional-grade tools into your routine, make sure to check out the link in the description below. Our fourth pattern is the elegant shrinking candles formation. This is the exact visual opposite of momentum. It refers to a sequence where the real bodies of the candles get progressively smaller and smaller as the price approaches a known supply or demand zone. Visualize an asset marching upward into a major historical resistance line. As it gets closer to the ceiling, the candles start looking tired. The bodies shrink from large to medium to tiny slivers. The underlying human psychology here is beautiful. It shows a systematic drain of buyer energy. The bulls are losing their grip, covering less and less distance with each session. It serves as a brilliant early warning system that the uptrend is exhausted and a top is forming. This pattern becomes lethally accurate if that final tiny shrinking candle is immediately followed by a massive long wick rejection right at the dead high of the zone. Finally, our fifth pattern brings us to the famous engulfing candlestick. This is an absolute titan among reversal signals. It's a two-candle sequence where a small candle of one color is completely swallowed, body and all, by a massive candle of the opposite color right next to it. When this structure manifests at the deep floor of a bearish run, it signals a violent transition of power to the upside. If it prints at the peak of an extended bullish rally, it warns you that the bears have staged a total takeover and are ready to slide the market down. Now that we've broken down the structural psychology of our core 5 candlestick patterns, let's transition into the second part of our masterclass. How to layer these signals with elite price action tools. Our first tool is the Fibonacci retracement engine. Imagine a strong trending market printing a beautiful impulsive leg upward, followed by a slow corrective pullback. You want to get into a long trade, but you want to buy wholesale, not retail. You grab your Fibonacci tool, click on the absolute low of that impulsive wick, and drag it to the very peak of the move. Instantly, a series of horizontal retracement lines populate your chart. As the price drifts down into these levels, they act as hidden support lines. But here is the insider secret. The precise zone sitting between the 0.618 and 0.786 retracement lines is what professionals call the Fibonacci golden zone. This specific pocket represents the ultimate sweet spot for catching the end of a correction, offering an incredible risk-to-reward ratio. The absolute best way to trade this is to sit on your hands, wait for the price to slide directly into this golden zone, and then closely monitor the candles for our 5 core price action signals. But remember, before you risk a single dollar on any strategy, you must backtest it across months of historical data to truly master its performance. Let's walk through a real-world chart setup. The market catches a massive bid, printing a clean, impulsive move to the upside that breaks right through a previous structural high. We map our Fibonacci tool from the low wick to the high wick, defining our golden zone between 0.618 and 0.786. Now, we wait for the pullback. As the price drifts into our zone, we watch the candles closely. First, we see a heavy bearish momentum candle, followed immediately by an indecision candle that closes dead in the middle with wicks on both sides, proving the bulls and bears are locked in a fierce stalemate. Then, boom, a massive bullish engulfing candle prints right inside the golden zone, signaling that institutional buyers have stepped into the market. Now, notice a major technical dilemma here. If we buy the exact moment that giant engulfing candle closes, our stop loss has to go all the way below the structural low. That means our risk bar is massive, and our risk to reward ratio will be less than 1-to-1 by the time the price hits the first major resistance target. We need a cleaner entry. To solve this, we zoom directly into a lower time frame, like the 15-minute chart, and reapply our Fibonacci tool exclusively to that new local bullish move. We wait for a minor micro pullback right into the lower time frame golden zone, allowing us to execute a highly refined entry with a microscopic stop loss, unlocking a massive reward potential. Our second master tool is a major level of market structure. This refers to a prominent horizontal line on your chart that has historically flipped roles, acting seamlessly as both support and resistance across multiple touches. Imagine a level that has recently rejected the price over and over again. When the price inevitably marches back up to test this zone, it presents a golden opportunity to hunt for a short position. You lock your eyes on the zone and wait for your candlestick confirmation. The moment a textbook bearish engulfing pattern prints right against that historical structural ceiling, you have your concrete logical reason to trigger a short trade. Our third essential tool is the trend line. A trend line allows us to visually connect the swing highs or swing lows of a trending market. In a clean uptrend, you map your trend line across the ascending lows along the bottom. In a downtrend, you trace it across the descending highs along the top. We draw these lines for two distinct reasons. First, they act as dynamic support and resistance boundaries. Second, a clean breakout through a trend line waves a massive flag that the overall trend is shifting. But hear me loud and clear. You must never enter a trade simply because the price touches a trend line. A touch is just an alert. You must always wait for a valid candlestick pattern to print at the intersection of that line. When it comes to drawing these lines correctly, there are 3 strict rules you must follow. Always map your trend lines from the absolute tips of the wicks. Never cut through the bodies. Constantly adjust the angle to capture the maximum number of historical touches. Absolutely never force a trend line. If it doesn't jump out at you naturally as an obvious structural feature, don't draw it. Let's bring all of these concepts together into a couple of real chart examples. Look at this 1-hour gold chart. We can easily draw a pristine, highly visible trend line tracking the trend. Suddenly, the market snaps below the line, giving us a major bearish signal. As we zoom into the price action right after the breakdown, we notice the price pulls back up to retest the underbelly of that broken trend line. This exact area perfectly lines up with a historical horizontal resistance zone that had previously printed long wick rejections. As the price approaches this dual resistance intersection, the candles begin to shrink, proving the bulls have lost their momentum. Then, right on cue, a long wick rejection candle prints, slapping the underside of the trend line. This is the ultimate alignment of clues, giving you a textbook setup to execute a highly profitable short position. Let's look at one more on the Euro-Dollar 1-hour chart. We map out a prominent major horizontal level of market structure that has flipped between support and resistance multiple times in the past. At the same time, we connect the swing lows to draw a clean ascending trend line. Look at that beautiful intersection point where our trend line and the horizontal support zone cross each other. This is a high confluence area, a spot where thousands of institutional eyes are staring at the exact same screen, waiting to buy. As the price dips into the crosshairs, an indecision candle prints first, showing a fierce battle for control. Immediately after, a massive, roaring, bullish momentum candle surges out of the zone. The bulls have officially broken the stalemate and taken total control of the room. This is your green light to go long and ride the wave up. That wraps up our price action masterclass for today. I truly hope this added massive value to your charting routine. If it did, please go ahead and smash that like button to show your support, and subscribe to the channel if you want to master these setups. I will see you all in the very next episode. Trade safe.